Good afternoon, friends. Myself, CA Raj Chawla. Welcome you all in this today's webinar on international taxation issue related to PE and foreign payments. Our today's speakers are CA Dipankar Gandhi ji and CA Mukul Gupta ji. They both are expert in the international taxation. So I request CA Mukul Gupta ji to please start this webinar. And I also request all of you, if you have any query relating to this subject, you can send that query on our WhatsApp group. And in case of any difficulty, you can contact Zenith at the given number 9711081083. Thank you, friends.
Good afternoon, one and all. I welcome you all to today's session on the permanent establishment and taxability of foreign payments. I am CA Mukul Gupta, and with me I have my colleague CA Dipankar Gandhi.
Good evening, everyone, and welcome to the webinar. I hope that we have an enlightened session and we have an interactive session wherein you also ask a lot of queries to us and we respond to them. To start off with, Mukul Gupta starting off.
So just a quick intro, Dipankar and me are working as partners in NDM Advisors. Apart from the general audit, GST services, we also have dealt extensively on international tax and foreign regulatory issues. And we hope that today we'll be sharing some of the practical issues with the audiences. Though a session of 2 hours is no way sufficient to cover an extensive issue such as P and foreign payments. However, the object of today's session is to cover the basics of international tax, and also so that you shall be able to have brief conversations with the clients on the issue.
Okay. So after getting an overview of the entire framework that we guys are going to basically follow. So the framework somehow is that we would be taking up section 195 basis which a payment is to be made to a non-resident from any person. Subsequent to dealing with various things in section 195, we would be taking up permanent establishment. So we would be going through the principles of permanent establishment and delving into it to a certain extent. Subsequent to 195. So to start off with this particular presentation in section 195, so what section 195 basically says is that any person responsible for making a payment to a non-resident, basically who's responsible for paying to a non-resident. So I'll be highlighting certain important terms in this particular definition. So it starts any person responsible for paying to a non-resident, not being a company or to a foreign company, any interest, not being interest referred to in these 3 sections, or any other sum that is chargeable under the provisions of this act, not being income chargeable under the salaries, this is an exclusion, shall at the time of credit of such income to the account of the pay, or at the time of payment thereof in cash or by issue of check or draft or by any other mode, whichever is earlier, deduct income tax thereon at the rates in force. Now let me just get on to terms that are important in this particular definition or in this particular clause of section 195. So it says any person. So one thing that we need to delve into is any person who would be responsible for deducting TDS under 195 when that payment is to be done to a non-resident. That is, we would be taking up whether a resident would be responsible, a non-resident would be responsible, or who would be responsible. Subsequent to it, the payment has to be to a non-resident. Then the important aspect would be that the payment is either interest or any other sum that is chargeable under the provisions of the tax. So whether a remittance, a pure remittance that is not chargeable to tax, or remittance that is not chargeable to tax under the Income Tax Act, how would it be, whether the tax would be levied under this particular section on that particular remittance or not. Subsequent to that, when should the TDS be deducted? Though a similar provision is there under the domestic tax laws, wherein we say that it should be done at the time of the credit or at the time of the payment, whichever is earlier. Again, we would be dealing with this particular aspect in reference to section 195 specifically and categorically. So before we start off with the international taxation angles, we can basically deal with the exclusions that are mentioned in this definition, that is section 194 LB, LC, LD. What does these sections deal with? And why are these basically excluded? So to understand, a very prima facie understanding is that because these sections already deal with the non-resident and they are being dealt specifically under this particular section, so therefore they have been excluded from section 195. So for example, section 194 LB specifically deals with interest paid by an infrastructure debt fund to a non-resident, and the taxability is at the rate 5%. Similarly, 194 LC deals wherein we pay interest to non-residents for basically money borrowed in foreign currency, and again the taxability is at the rate 5%. Now in section 194 LC they have defined whether the loan can be taken from this to this period, and so basically the period is 1st July 2012 to 1st July 2020. So it can be through a loan agreement, it can be through a long-term infrastructure bonds, it can be through long-term bonds including long-term infrastructure bonds. So this is depending upon the periods. 194 LC basically deals with that. 194 LD deals interest paid to foreign institutional investors and qualified financial institutions. Again, when the interest is paid to them, TDS would be applicable at the rate 5% under 194 LD. Now, because we have specific sections for the payment to non-residents categorically dealing, we don't have these covered under section 195. Now, going on the next slide. Again, as I mentioned, the terms that were pretty important. So, any person responsible for pay to a non-resident or a foreign company. Now, these two terms we have already seen that we would be dealing basis the case laws that who is responsible for deducting TDS, whether resident, whether non-residents. In subsequent slides, we would be covering those particular aspects. Now, all the payments are covered under section 195 for the deductibility of TDS, except there are certain exclusions that are basically made. The first exclusion is that is mentioned in section 195 itself is payment of salaries. That is not included in section 195. Subsequent to that, in the provisos, basically, what they say is, one proviso says that when there is a payment that is made by a public financial institution or a public sector bank, a payment of interest made by public sector banks and public financial institutions, then they would be deducting TDS only at the time of payment. So basically the rule wherein we say that whichever is earlier, the credit or the payment, would not be applying here, and it would only be the payments, it would only be the TDS would be deducted at the time of payments. Now, what are public sector banks and what are public financial institutions? Basically, it's section 10, clause 23D that deals with it. A public sector bank, to give you an overview, State Bank of India and other public sector banks would be covered under a public sector bank. And as far as public financial institutions are concerned, institutions such as ICICI Bank, IFCI, IDBI, LIC, UTI, IDFC. So if these institutions pay a certain interest amount, then the TDS would be deducted at the time of payment rather than getting into that line wherein we say that credit or payment, whichever is earlier, only at the time of payment. And second proviso basically deals if any domestic company pays a dividend, then there will be no deduction of TDS. Now, subsequent to this particular section, as mentioned earlier, refers to time of deduction, that the TDS is to be deducted at the time of the credit or the payment, whichever is earlier. Now, so explanation one basically mentions that in a case wherein you have credited certain amount in suspense account, or let's say interest payable account, then in that particular scenario, you would be required to deduct TDS in any, if you credit these particular interest in the suspense or interest payable account. Now, if we think a very practical scenario, now I'm going to waver a little bit from section 195 to the domestic sections as well, because this particular clause, this particular line wherein the amount is credited to a suspense account or any other account, like interest payable account, if the amount is credited, then you need to deduct TDS. This is there in the domestic provisions as well. This is there in section 195 as well. So in case, let's understand this particular scenario wherein if we say that okay, why would revenue authorities bring in this particular clause stating that if an amount is credited to a suspense account or interest payable account, you have to deduct TDS. Now, the basic understanding or the basic reason why revenue authorities did this was so that a person who is responsible to deduct TDS, in spite of knowing the amount and in spite of knowing the pay, in spite of knowing the amount and the pay, does not deduct TDS. So they wanted to avoid that particular reason. So what they wanted to do was that in case a person who's paying a certain amount knows the pay and knows the amount, should go ahead and deduct it. So certain people, certain entities, what they were doing is they were crediting certain amount to a suspense account and obliterating their the responsibility that was given by the revenue authorities on them and stating that okay, we have put this amount in the suspense account on the interest payable account and you will not be deducting TDS because we need to understand this particular thing that that the language that is mentioned is that the amount paid, TDS is to be deducted at the time when the amount is paid or when it is the credit of the income to an account of the pay. So what happens in case we do not know the pay? So that will be a very genuine scenario wherein it will be very difficult for us to deduct TDS, right? So I would now go back to the legislature intent, wherein the intent of the legislature, wherein before bringing this particular clause in various sections, including 194A, 194C, the clause relating to the suspense account, what the revenue authorities basically wanted to say. So this thing is not covered in the PPT, but otherwise, if someone wants to write down, it can be pretty helpful. So to start off with, we should understand that we maintain our accounts on a mercantile system of accounting, wherein we record on the accrual basis, we credit certain things on accrual basis. So the revenue authorities came out with an instruction number 1215 in 1978. Until that time, this particular suspense account provision was not there in the Act. So in that particular instruction, what revenue authorities were mentioning is that these particular sections mentions that at what time you need to deduct TDS. Now, to understand at what time you need to deduct TDS, you need to understand that what do you basically mean by the expression credit of income to the account of the pay. So these words basically.
I think it's not connecting. Hi everyone. I think there's some problem in the webinar. Can you all please confirm over the WhatsApp group that you are connected and able to hear us? Zenith, I think it's not connecting.
उनकी सर्वर का इशू है, मैं बात करती हूँ।
I have come to attend your seminar live.
Okay. Oh, that's great. So you are a CA?
Yes,
Oh.
I qualified in 2006.
Okay, great.
That's great. Presently working in Italy school. Actually, we have so many international payments.
Oh,
So
Okay.
I
great,
think it's
great.
good to have a face-to-face interaction.
Absolutely.
Connected and clear. Okay.
Okay, so can you anyone?
Hi everyone. So I just got the confirmations that people are connected and the session is clear. Yeah, we are getting the confirmation. So I think we'll resume. So yeah, Dipankar was discussing about suspense account.
No, so we need to understand where was the connection lost. Let's just a minute. Give us a minute to understand where was the connection lost.
Connected, but there is a lot of back disturbances.
Okay, we would just wait for a minute or two to understand that the webinar is absolutely clear for everyone.
Disturbances.
Explanation can explanation to my address. I think we should resume because confirmation. Connection, but there is a lot of back disturbances.
Correct है कि yes right भी आ रहा है बाद में.
नहीं वो
No,
उसी
they
के
are
लिए
saying
बोल रहा
connection, but there's a lot of back disturbances. I think we should start.
हूँ.
मेरे ऑफिस वाले भी कर रहे हैं।
एक बार
Can you just check?
ऑफिस वाले भी
चेक कर लो.
एक लिंक वहाँ पे देके आए। आप लोगों को एक्सेस हो पा रहा है? जस्ट टू कंफर्म। नहीं वो कहीं पे प्रॉब्लम आ रही है तो हाँ 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 ठीक, आप लोग देख पा रहे हो ना? ठीक ठीक
Audible as well.
Available to audible.
Okay, so I think so we should resume with the presentation. So continue. So I'll just go back a little bit and say that okay, to understand the suspense account, what was the reason of bringing in this particular provision wherein we say that if anything is credited to the suspense account, then in that particular case also a TDS is to be deducted. So going back, and I'll connect the domestic provisions as well as the section 195 to it. So section 194A, 194C, 195, these all these sections have this particular explanation or a proviso related to if an amount is credited to a suspense account, then also a TDS is required to be deducted. Going back to a instruction 1215 of it's dated 1978 basically. It's 8 November 1978. There, the revenue authorities were basically discussing that what should be the time when the TDS should be deducted, and that time this particular provision of suspense account was not present. So what they said was that the ultimate either the amount should be credited to the pay, or there should be an intent to clearly transfer that particular amount to the account of the pay. So just by putting an amount to a suspense account, you would not be liable to deduct TDS. But please remember, this was a scenario wherein no explanation of proviso regarding this particular crediting to suspense would be liable to TDS was present. Subsequent to this 1978 instruction, there was a letter, again reinstate letter in 1975 by the revenue authorities, again reinstating this particular thing, that just by putting an amount in the suspense account, you would not be liable to deduct TDS. It has to be a constructive payment. Subsequent to this, CBDT came out with a circular in 288, wherein they very categorically mentioned that it has to be a constructive credit to the account of the pay. Now, what do you mean by constructive credit is? Now, as I mentioned earlier, the reason for bringing in this particular explanation, one that is related to suspense account or provisions related to suspense account in the domestic sections, was some people who were trying to avoid taxation were putting certain amounts to the credit in the suspense account and not deducting TDS in them. Revenue authorities brought in this particular provision so that if anything is put in the credit of suspense account, you deduct TDS. So what revenue authorities clarified by this particular circular, and the circular is basically circular number 288 of 1980. They said that if it's a constructive credit to an account of a pay, then you need to deduct TDS. But in case there is a very genuine problem to the payer where they do not know the pay, in that particular case, you are not required to deduct TDS. I'll get on to a practical example wherein you might not know a pay and what should be these provisions would be very helpful. And I'll just hop on to one particular case wherein they have dealt with this particular circular, and the case is IDBI versus ITO, wherein the Honorable Mumbai ITAT has mentioned this particular aspect, wherein they have said that only when it is a constructive credit to account of the pay, a TDS is required to be deducted. Just because you have put a certain amount in the suspense account, and in case you do not know the payee, then it would not be possible for you to deduct TDS. So there are a lot of litigations that would go on. Now, a practical experience on this is that let's take an example of telecom companies. Now, certain telecom companies, all of us have seen towers that are put on for telecom companies on barren land. Now, those land is taken by a telecom company for, let's say, 15, 20 years. And those lands have to be given back to the landowners. And the landowners say that we want that particular site on an as-is basis. So when you install such towers, you would obviously spoil that land a little bit. So the landowners want that land after 10, 15 years of lease in as it is basis. So what happens is that telecom companies at that particular moment, when they take that particular land and install the equipment, they know that a certain expense is to be done after 10 years or 15 years. But now they don't know whether who would be the payee, who would they be paying, whether they would do it internally, whether they would take a vendor. So in this particular case, they do not know who the payee is. So today when they make a particular provision for a payment, so how would they basically deduct a TDS when they do not know payee? So in those particular scenarios, this suspense, the discussions that we just had about instructions and the circulars and the constructive credits are very, very helpful in such cases.
So Dipankar, this means that in case my provision is ascertained, I know that who is the party and what is the payment to be credited to that party, then TDS liability would occur. In any other case, if it's just a provision, if I've just allocated an amount wherein the party or the exact amount of payment is not certain, then TDS provisions would not be applicable. Is it right to say that?
See, when there are so many circulars, instructions, there's no straight yes or no to a certain, and especially in taxation, when there's so many litigations involved, you can't really say yes or no, but yes, to an extent, yes. And to state a yes, one, I've stated all the circular instructions in the cases. Along with that, look at the practical difficulty. How would you deposit the TDS that you have deducted?
Right.
In whose name would you deposit the TDS that you have deducted? Because you do not know the party. So the machinery of depositing TDS would also fail in case a payee is not known. Right. So not only the legal provisions, even the practical provisions are failing in case you do not know the payee. So just because you have credited a certain amount in the suspense account, and the law is saying that because you've credited a certain amount in the suspense account, you need to deduct TDS, but who is the payee against whom you're going to deduct TDS and how are you going to deposit the TDS are very big questions. So when the revenue authorities come and say that, okay, you have to deduct TDS, we go back and say that, okay, we would deduct TDS, but you tell us that who is the payee for whom we should deduct TDS and how to deposit it. So that these are some of the legal arguments that we might just go ahead with.
Right.
Okay. So explanation 1 is covered in this particular aspect. So there is an explanation 2. Again, that was inserted post the Vodafone case. I'll just read the explanation, and while going forward, this Vodafone, when we would be discussing the Vodafone case, you would understand why this explanation was basically inserted. Now, what explanation 2 says is, for the removal of doubts, it is hereby clarified that the obligation to comply with subsection 1 of section 195 and to make deduction thereunder applies and shall be deemed to have always applied and extend and shall be deemed to have always extended to all persons, residents or non-residents, whether or not the non-resident person has a residence or a place of business or a business connection in India or any other presence in any manner whatsoever. So, in spite of the fact that whether you have a place of business, whether you have a business connection, whether you have any kind of a presence, even non-resident who's paying a certain amount, and how we would be discussing in subsequent slides when we discuss the Vodafone case in relation to section 195, even a non-resident has to basically deduct that particular TDS when they are paying to a non-resident. Now there was a certain decision in the Vodafone case that we would be discussing, and after that particular decision, this particular explanation was introduced. And why? Now, what is the explanation? Now let's get on to the next slide, and Mukul will take you over through that particular slide.
So we are still on section 195. We'll quickly discuss about the rate of deduction. Now, this is a point where maximum of the tax practitioners really have a tough time in deciding what rate should be applicable, what are the provisions. So we'll see that there's a chain of sections referred here. Now, if you see the rate of deduction, as per section 195, the TDS is to be deducted in case of international payments at the rates in force. Now, rates in force, the term has been defined in section 2, subsection 37A. Now, this particular provision says that the TDS shall be at the rate prescribed in the Finance Act or the DTAA, whichever is applicable under the provisions of section 90. Now, this takes us to the provisions of section 90. Section 90, subsection 2 says that TDS shall be applicable under the provisions of Act or DTAA, whichever is more beneficial to the assessee. So there's a complete change. Section 195 takes us to section 2, subsection 37A, which further takes us to section 90, subsection 2. And ultimately, in a nutshell, there was a circular 728 dated 30th of October 95, which summarized the entire gamut of rate of deduction, and it said that in case of a foreign payment, the TDS is to be deducted at the rate which is prescribed in the Finance Act, which is the Schedule to Finance Act, or the double tax avoidance agreement, whichever is more beneficial to the assessee. And also it is to be understood that surcharge and education cess are not to be applicable in case the payment is made taxable under the DTAA provisions. The simple reason being that surcharge and education cess are domestic levies which have been levied by the Income Tax Act, that is Indian Revenue Authorities, and DTAA and Indian Revenue Authority Income Tax Act does not override the provisions of DTAA. Therefore, in case a payment is taxable under DTAA, education cess and surcharge is not to be applied. Now, take an example. If you have a royalty or an FTS payment, which is taxed at rate of 10% under the provisions of the Act, as well as the provisions of DTAA, then it's better you take the same under DTAA because you are saving on the surcharge and education cess. That was about rate of deduction. Now we come to the responsibility for deduction. Now the provision is quite straightforward. Section 204 says that in case of foreign payment, the responsibility for deduction lies with the payer, and payer has been defined as the company, any company which is responsible for making the payment. So Indian company making payment overseas is required to deduct tax. Now whether a non-resident company who's making payment to a non-resident, whether TDS provisions would apply in that particular case, we'll see in the subsequent slides. Okay, we are getting some of the questions. We'll try to take up the questions at the end of the particular provision or at the end of the seminar. So we have a question on 195. We'll try to cover that up when we are at the end of section 195. Now, furnishing of information. Subsection 6 of subsection 195 mandates filing of Form 15 CACB, which is prescribed under Rule 37 BB. Patul, would you like to clarify on 15 CACBs?
So basically 15 CACB is something that at the time of foreign remittances we need to issue. And it's a mandate on the chartered accountant to basically issue a 15 CB at the time of foreign remittance. Now there is a question wherein you have asked that for the whether we need to issue Form 15 CACB for the payment of import of goods. Now, to tell you very frankly, import of goods would not levy to any TDS because it's good involved. But what happens is on a prudent basis, what we say is in case of any foreign remittance, you need to basically issue a Form 15 CB. Now, if I go through a particular provision of section 195, we're going to have that. So what subsection 6 says is, now the person responsible for paying to a non-resident, not being a company, or to a foreign company any sum, whether or not chargeable under the provisions of this act, shall furnish the information relating to such payment relating to the payment of such sum in such form and manner as may be prescribed. So they have mentioned whether or not chargeable under the provisions of the act, you need to inform. So on a prudent basis, yes, the answer is yes. You furnish it even though the amount is not taxable, but you please do furnish that particular certificate, because that is required by the authorities, and you would not like that for a single payment. That too, that was not taxable. Authorities would come back to you because non-furnishing of a certain certificate.
Okay, so we are getting some of the questions. We'll just quickly take up the questions. One of the questions is that foreigners insist that the payment is taxable only in foreign country. So for this particular practical problem, there has to be a constructive discussion with the client, and you have to highlight the points that as to why. See, firstly, Act has to be analyzed, and then DTAA has to be analyzed, and then specific documents that are required by the Indian revenue authorities are to be collated. We'll come to that in our discussion.
I would just interrupt in between, and because there's a query wherein they say, please elaborate the word other sums written in section 195. So basically what I understand is that you need to understand that what do you mean by or any other sum chargeable under the provisions of this act. We would be coming to this when we would be discussing a Supreme Court judgment in the case of G, and we would discuss what do you mean by other sum that is chargeable under the provisions of the act. So your query would be answered subsequently. I should do it.
Yeah. Okay, so one quick question. Chetna Sharma is asking whether 15 CBs to be issued even if it's a non-taxable remittance. See, 15 CA CB practically is required because a CA in case of 15 CB is required to certify that what is the reason that the payment is non-taxable, furnishing the various clauses of the DTAA and the Income Tax Act, which make the payment to be non-taxable. And it's also important to understand that this particular documentation is important from a perspective that your foreign remittances, which are made through 15 CACBs, might get picked up for scrutiny assessment by the International Tax Board. So it's important to furnish 15 CBs, and you have to justify that why the payment is non-taxable.
Just to add on to this particular aspect, whatever the questions related to 15 CACBs are concerned, see, we need to understand one thing, that we from our side have analyzed that this particular transaction is taxable or not taxable. How would the authorities get to know that whether our analysis? So they would always want their analysis to be done. And what they say is that if you do not furnish, now this is something practical. They say that if you do not furnish these particular certificates, we are not in a situation wherein we can say that whether the transaction was taxable or not. So for us to understand whether the transaction is not taxable, at least furnish a 15 CACB, and if it is not taxable, it's fine with us, but you need to furnish it. Now this is something practical.
Okay, Mr. Maninder Singh has a question regarding whether it is chargeable or not. So it's a very fact specific question. We'll let us discuss at the end of the session that what is your specific payment, and whether in case it gets answered during the session, then it's okay, otherwise we'll separately take it up. So now we are coming to the interest on failure. It's also important to understand that under the provisions of section 201 of the Act, in case there's a failure to deduct TDS, that is, there's a short deduction of TDS, interest is levied at 1% of the amount of the default amount. And in case there's a failure in deposition of the TDS after deduction, that means if you have hoarded the TDS and not deposited to the government, then there's a higher penalty of 1.5% for a month or a part of a month, during which such default continues. Now we move to the next slide. Okay, so we'll be taking some of the tax controversies. So this is somebody just charged in case of capital transfer, in case property is transferred from a person to another, to within from a resident to non-resident, or vice versa. So this is a case of this is the landmark decision of Vodafone International, wherein the stake in the Indian company, namely Hutchison SR, was transferred via a special purpose vehicle which was situated in Cayman Island. And the question, so it was a very lengthy judgment, but the portion which is relevant for today's seminar is the question that whether the expression any person, which is used in under section 195, covers a non-resident as well. So in this particular case, the shares of Indian company were being transferred between two non-residents, and the question arose before Supreme Court whether any person would would also include a non-resident, and a non-resident while making payment would be required to deduct TDS under the provisions of the Income Tax Act under the provision under Section 195. So the Supreme Court held this para highlighted in bold, the expression any person, in our view, looking at the context in which Section 195 has been placed, would mean any person who is a resident in India. So Supreme Court clearly mentioned that Section 195 would not be applicable in case of non-residents, in case a non-resident is making payment to another person. However, pursuant to this particular ruling, the Income Tax Act was amended, and Section 195(1) was amended to clarify that any person also includes a non-resident. You can refer to explanation 2 to Section 195.
So Mukul, can we then say that earlier, prior to 2012, what Supreme Court and we used to understand was that any person would be a resident, and only a resident when making a payment to a non-resident would be required to deduct TDS under 195. But it is only after this particular case, as we mentioned earlier, an explanation 2 was inserted, subsequent which now a non-resident, be it a non-resident or a resident who would be required to make a payment, would be required to deduct TDS now.
See, that's a retrospective amendment, and therefore any person who was, so it will always be believed that the intent of Section 195 was always that any person, that it is applicable on residents as well as non-residents. Therefore, those particular payments would be taxable in which a non-resident is making payments to a resident or a non-resident. Now, to understand this, we have a quick illustration through this diagram. If you go through this diagram, there's an Indian company named Indco Private Limited, which is a wholly owned subsidiary of FCO Private Limited. So the shares of Indco Private Limited are held by FCO Private Limited. FCO Private Limited is established somewhere in country A, and Indco Private Limited is obviously an Indian company. Now, in case the shares of Indian company are transferred to a company F2, which is located in country B, then the question arises that whether provisions of Section 195 would be applicable and whether FCO 2 would be required to deduct TDS on the payments made to FCO. Now, this is a case which we recently dealt in one of the cases, and this is a practical problem that was also raised by somebody in the WhatsApp group, that when there is a non-resident to non-resident transfer, it is very difficult to convince the clients that this transaction would be taxable in India. However, it is very important to understand that the law now, after the amendment to the provisions of Section 195 that we just discussed, the Vodafone amendment, now the law is very clear that this particular transaction would come under the ambit of 195 and TDS would be applicable. Apart from TDS, under 195, we also need to check the provisions of DTAA with the respective country in case the transaction is applicable as per the analysis. In case the transaction is taxable in India, then the companies have also to obtain PAN, TAN, file their income tax returns, do the TDS obligations, and also transfer pricing provisions might get triggered. So that is something which people have to be very careful. Now we come to another case, another tax controversy rather. In the case of Transmission Corp. So Transmission Corp is the Andhra Pradesh State Electricity Board, to put it simply, and it was making some payments to the non-resident Switzerland-based companies on account of machinery, purchase of heavy machinery and its installation and commissioning related services. So there were 4 contracts that the Transmission Corporation entered into. Out of them, 2 were for the supply of machinery, and balance 2 contracts pertained to the services for installation or servicing or AMC. So the question that arose before the courts was, before the High Court, was whether the TDS, so it was a composite payment which was being made, which a certain portion of the payment pertained to machinery, on which obviously TDS is not applicable, and certain portion pertained to the services on which TDS is applicable. So since it was a composite payment, the question arose whether the TDS was required to be deducted on the entire payment or only on a certain specified payment. So on this, the matter reached to the High Court, and the High Court said that TDS provisions are only a machinery provisions, and therefore TDS should be deducted whether the company or the payment was ultimately liable to TDS or not can be deducted, can be decided later on at the time of scrutiny when the company files its income tax return. So this is what was held by the High Court. The matter further traveled to Supreme Court, and the Supreme Court reversed the ruling of High Court, saying that the taxpayer making the remittance to non-resident was under an obligation to deduct TDS under 195. However, TDS was required to be deducted only on the sum which was chargeable to tax and not on the entire payment. And the Supreme Court also made an observation that in case the assessee was not sure on what portion was it required to deduct TDS, then it could have approached the assessing officer.
Okay. Before we go forward to the next case, there is a question from Kavi. What I understand that the query is not very clear, but what I understand is that there is a certain problem in understanding the rate of TDS. See, what we discussed earlier was in relation to when the TDS obligation would not be applicable is when you do not know who the payee would be, whom you want to pay to, or what amount exactly do you want to pay to. In that particular scenario, we can take an argument that, okay, I do not know the payee, I do not know the exact amount that is to be paid, and therefore I cannot levy an exact TDS, especially in the case of not knowing the payee. Because in case you know the amount to a certain extent also, then also the officer can come back and say that, okay, you could have deducted amount to this particular extent. But in this particular case, what I understand is that you are not able to determine a rate. A rate is to be determined basis understanding the nature of the transaction. Now, whether a transaction would be categorized under royalty, whether a transaction would be categorized under FTS, is it an interest payment, or then a permanent establishment, whether it is being here, whether a permanent establishment is in India or not, the tax rates are to be determined basis understanding the nature of the payment. So the nature has to be analyzed to understand the tax rate. Okay. So now going forward with cases only, the next case again a very landmark judgment in respect to section 195 is a case of GE India Technologies Service Private Limited. Now the brief facts of this particular case was that GE imports softwares and shrink wrapped standardized softwares from Microsoft and companies basically like Microsoft from outside India, and they used to pay for importing these softwares to these suppliers outside India. Now what GE says is that I only pay the cost and there is no income element that is involved in these payments. Whereas when the revenue authorities come back, the revenue authorities say that along, it is not only the cost, the license is also involved and you also pay a license fee, and it should be categorized under royalty. Post going through all the lower levels of appeals, finally what Supreme Court said was, and revenue authorities also said one more thing before the appellate authorities, is that if you want to determine whether you have to deduct TDS or you do not have to deduct TDS, you before come to us. So you need to come to us before having an understanding whether to deduct TDS or not under subsection 2 of section 195, and we would give you an order telling you whether you need to deduct it or not. So here what Supreme Court basically said was that, and here we would be dealing with what do you mean by other sums chargeable to tax, income chargeable to taxes, that if we take the contention of the revenue authorities and we say that any remittance that is to be given outside India, TDS would be, that is tax would be levied on that, then the entire intent of this section would go. And the reason why they say so is that it is only under section 195 that they have categorically mentioned sum chargeable under the provisions of the Act. In all of the sections, what they say is any amount of payment, other sums paid. It is only under this particular section that such terminology is being mentioned. And when the legislature has an intent to use such a terminology, they specifically and categorically want to say that only the sums that are chargeable under the Income Tax Act would be liable would be liable, wherein the person who's paying would be responsible for deducting TDS. Now, basis this particular decision, it was decided that not all remittances that are made to the non-residents would fall under Section 195, but only the remittances that are chargeable to tax would fall under the Income Tax Act. There was one more very important thing that Supreme Court had mentioned. The Supreme Court had mentioned that we cannot really read one section, Section 195, in isolation. What we do have to do is we need to read the charging sections along with Section 195, and we need to see Section 4, we need to see Section 5, we need to see Section 9 along with Section 195, because the Income Tax Act is an integrated code, is one code, and the same thing was said again previously by the Supreme Court in the case of LIV. So when on reading the Income Tax Act together, and by reading this terminology, other sums chargeable, only the sums that are chargeable to tax, Supreme Court emphasized that the non-taxable remittances would not be covered under 195, and only the chargeable or remittances that are chargeable to Income Tax Act would be covered under Section 195.
Okay, so we have a question from Chetna. I think Chetna, your question just got answered. Your question was whether on sale of property TDS has to be deducted or not, and whether we have to approach an AO. So I think it's squarely covered. We have another question that as per specified list under Rule 37BB for payment of import required to be furnished in 15 CSCB, kindly advise. Okay, so yes, as per the provision, or theoretically, yes, you are not required to furnish 15 CSCB in case you are making any payment for goods. However, the banks, certain banks still insist on getting 15 CSCBs. So practically, you will have to approach a CA for getting 15 CSCB. But theoretically, as per the provisions on in case it's a purchase of goods, then 15 CSCB is not required.
And as discussed earlier also, and as just now mentioned by Mukul, you would practically require a 15 CB, because be it the banker, be it the revenue authorities, even in spite of remittances in the case of goods, the proviso basically says that whether chargeable or not chargeable to tax, you need to furnish that particular letter, because the revenue authorities would always come back and say that, okay, you have estimated that this amount was not chargeable to tax, but how would we get to know that particular thing? So for that particular practical purpose, and to comply with the legal provisions to a certain extent, not exactly, you need to practically furnish a 15 CSCB in this particular scenario also. Okay, going on to the next case. Now the next case is also a very interesting case, because this case is a judgment given by Bangalore ITAT in the case of Said Aslam Hashmi and R. Prakash. Now what the case is basically that the assessee here is a non-resident outside India, of course, and he is the purchaser of a property, a residential flat. Now that is located in Bangalore. The flat is purchased from, that is the seller of the flat is Srimati Gitanjali. Now as per the assessee, the seller is located in Pune in India. This is what the understanding of the assessee is, but in the agreement, the sale agreement, the address that has been mentioned by the seller pertains to that of Hong Kong. Now the revenue authorities say that because now the seller is outside India, you would be liable to, and now the NR to NR payments are obviously covered. We all know that. We have had a discussion to that. So the assessee who is already a non-resident would be required to deduct TDS, and he was required to basically deposit TDS, and because he has not done so, a litigation under Section 201 subsection was initiated. Now the assessee takes a plea wherein he says that I was under an impression that the seller would be in India. So when I pay the particular amount, the seller would pay tax in India, and there would be no non-compliance. But here the Bangalore ITAT very categorically mentioned that, and there was one more plea that was taken by the assessee, is that the professional advice that I got never mentioned that I had to deduct TDS under Section 195. So what the Bangalore ITAT said was, be it a professional advice or be it an assumption that you were under, that the seller is in India, but the fact is that the seller is outside India in Hong Kong. That is what is mentioned in the agreement, and the seller has not filed the return, and neither has the seller deposited tax in India. So therefore, you are here liable to pay taxes, that is, you should have deducted taxes on the entire sale consideration. Now, why I'm emphasizing on the entire sale consideration is because the entire sale consideration, what Bangalore ITAT here says, that you are liable to deduct TDS on the entire sale consideration, is in contrast with the Supreme Court judgment in the case of GE and Transmission Corp that we have just mentioned. Because what GE and Transmission Corp just mentioned was that the amount that is chargeable to tax. Now, the entire sale consideration is not chargeable to tax. You reduce the cost of acquisition, you have a capital gain, and that is chargeable to tax. But here, the Bangalore ITAT said that the entire sale consideration was chargeable to tax, and therefore you are liable in respect to the entire sale consideration. So this decision is an important and interesting decision. So we thought that we would bring this forward to you. Now, along with this decision, there was a very interesting case that we saw. So suppose that. And this case is basically United Breweries Limited. So this case is not there in the PPT, just for the sake of discussion. We thought that we would discuss this case with the participants. What happens that at the time when we make a certain payment, the person who we are paying, so let's say as a resident we make a payment, and to the person whom we are paying was a non-resident when we were liable to make the payment. So what happened in this particular case was, what happens that if that person was a non-resident at the time of making the payment, but subsequently it became a resident. So what happened in this particular case was that the assessee was required to make a certain payment to a non-resident, and because it is a foreign remittance, the assessee applied to the FEMA regulations, as per the FEMA regulations, to the RBI for taking the approval for the outward remittance. RBI took its time, and at the time when the permission was received from the RBI, at that particular point of time, the person to whom the payment was to be made became a resident in India rather than a non-resident. So in this particular scenario, what happened was that the Karnataka, so this is a Karnataka High Court judgment in the case of United Breweries, the Karnataka High Court said that what is required to be seen is the time when you were liable to make the payment, what is the residential status of the pay. So in this particular case, at the time when there was a liability to make a payment before taking the permission of the RBI, or at the time of taking the permission, the person was a non-resident, and therefore section 195 would be applicable in this particular case, in spite of the fact subsequently the residential status of the person changed to being a resident in India.
So we'll just quickly take up two queries from Kavi. First query pertains to the NR bills and payments at the year end, wherein they are outstanding for some reason for 15 CACB for applicability of TDS, and the TDS applicability is not known. So I think this is already covered. So that is not the subject matter of today's discussion, but there are case laws which say that three things are to be evaluated. Firstly, whether the amount is ascertainable. So if the amount of payment is ascertainable, that has to be seen. Number two, the party is ascertainable, and there is an acknowledged debt, which means that the services have been provided by the party to you, and you have an acknowledged debt. In case that particular payment is remaining unpaid, or that is credited to your books of account during the end of the financial year, then yes, TDS provisions would be applicable. We have another query from Kavi saying, does the definition of NR also cover foreign government agencies? So yes, so we'll be coming to the definition of NR and the scope of Income Tax Act in subsequent slides. But yes, just to answer in brief, foreign government agencies would also be covered in non-residents. Non-resident covers anything that is any person, any legal entity which is not a resident as per the Income Tax Act. Now we'll come to the next slide. We'll just go through one of the CBDT circulars. This particular circular says that in case of failure to deduct tax at source while making remittances to non-resident, the assessing officer shall determine the portion of the remittance chargeable to tax on which deductor shall be deemed to be an assessee in default. Now, while determining the same, facts and circumstances of each case have to be analyzed. Now, this particular circular indirectly says that a person is required to make deduction of TDS only on the portion of the remittance which is chargeable to tax. Now, this particular circular is specifically important because it has been referred in the subsequent slides and in subsequent circulars as well. So if we come to CBDT Circular number 3 of 2015, it says that for the purpose of calculating disallowance under Section 40A, which is the disallowance in case you fail to deduct TDS, in that particular case, the sum chargeable shall be considered as per Circular 2 of 2014, which we just discussed, which means only the taxable portion is to be considered. Now, a question for consideration arises that who determines that what is the sum chargeable for deduction of the tax at source under 195, whether it's the payer, whether it's the income tax department, whether it's the assessing officer, who decides? Another thing is that what is the role of CA certificate in the form of 15 CAC in the form of 15 CB in foreign remittance, and whether the same is a sufficient compliance. So we have partly covered this in the earlier slides, and we'll be covering it further in our ensuing slides. Next, we go through the provisions of the Income Tax Act. Section 4, which is the charging section of the Income Tax Act. Section 5, which says or defines the ambit of the scope of total income. Section 6, which defines the residence and lays down rules for various types of residential statuses as per the Act. And Section 9, which talks about income deemed to be accrued or arising in India.
Mukul, I would just take up I would say a discussion that is going on in the group before we get into discussion with Section 5 and 6. So what basically discussion is going on is in case of a sale proceeds, because the Bangalore ITAT decision is there. So do we require a lower deduction certificate every time? See, this is a very fact specific question, and I say fact specific question is because it depends upon the risk taking capacity, I would say, of the person who is making the remittance. Now, if the person is absolutely clear on the provisions that we are discussing that Section 195 is only applicable on the sum that is chargeable to tax, and the sum that is chargeable to tax is only the amount pertaining to capital gain and not the entire sale consideration, then in spite of not having a lower deduction certificate, we can go ahead and make that particular remittance and deduct TDS only on the amount of capital gain. But in case we need to be pretty prudent, in case we are averse to litigation, in case we do not want to get into any complications and any litigations, then yes, of course, you need to go to the revenue authorities and ask for a lower deduction certificate. So it depends upon the capacity of the assessee to get whether they want to get into that particular litigation and controversy or stay away from it. That is the only way that you need to. So there is no prescribed law wherein you need to take an LDC in case of sale consideration. You do not need an LDC. If you have a capacity to face the litigation and to prove your point, do not take an LDC. Take a stand wherein you deduct TDS only on the capital gain. If you do not want to get into litigation, go and take an LDC. That's it.
Now, coming back to the provisions of the Act, Section 5, which talks about the scope of total income, broadly speaking, a resident in India is taxed on the global income, which means any income earned by a resident in India or outside India would be liable to tax in India. And in case of a non-resident is taxable only on the India-sourced income, which means any income which is not sourced in India and which is earned outside India, which does not have an India connection, will not be taxable in the as per the Income Tax Act. Now we have tabulated here a summary of the provisions of Section 5. So first, any income which is received or deemed to be received in India, it is taxable. In case it is India sourced, it has to be taxable. Whether you are sitting in India, whether you are sitting outside India, whether you are a resident or a non-resident, any income which is arising from India or deemed to received in India is to be taxed. Now, second is accrues or arises or is deemed to accrue or arise in India. In this particular case also, as I said, in case it's an India sourced income, it has to be taxed in India, whether you are a resident or a non-resident. Now, third is the typical and the tickling category, which is the income which accrues or arises outside India. Now, this is a very specific thing wherein analysis is required. Any income which arises outside India may be divided into two parts. Firstly, the income which is derived from business controlled or a profession set up in India. That means if you have a profession or a business in India and you are earning any income from that, in case you are an ordinarily resident, then yes, it is taxable. In case you are not ordinarily resident, yes, it is taxable. However, in case you are a non-resident, then it would not be taxable. Now we come to any other income that accrues or arises outside India. In that particular case, or in case you are a resident, obviously it has to be taxable. In case you are not ordinarily resident or you are a non-resident, then it is exempt, then it is not taxable under the Income Tax Act. So now we move to the chargeability provisions. So section 6 briefly talks about chargeability of various taxpayers categories. First is individual. In case of individual, the physical presence of the individual has to be seen. In case of determination of the of his residential status, in case of HUF firm or AOA, it has to be seen whether the control and the management is wholly is whether it's in India or it's outside India. In case of a company, and a company which is registered in India is obviously resident in India. In case of a foreign company, it has to be seen if it has a POEM in India, that is place of effective management in India. In any other case, it is considered resident except where the control and management is situated wholly outside India.
Okay, just a confirmation, is the webinar working for everyone? Because there was someone has just mentioned that the webinar.
Can you please confirm over WhatsApp in case the webinar
Can
is
you
working?
please confirm once? So if you guys can please confirm, we're waiting for the confirmation. Okay.
Okay, it's working.
Okay, Chetna, we have got your confirmation.
So I think Swati, you can just refresh your page and it would be working.
Okay, so we'll be.
So now we come to section 9. So section 9 is quite an elaborate section, but what we'll be covering in brief, what we intend to cover that is relevant for this particular seminar. Briefly stating, section 9 says that an income is said to be deemed to accrue or arise in India if the same is accruing or arising directly or indirectly through a business connection in India, from any property in India, from any asset or source of income in India, or from any transfer of capital asset in India. And it also, the last point also refers to any share transfer that wherein the share value of the share is derived substantially from an asset in India. Here we are referring to the Vodafone case that we just discussed, the indirect transfer case.
Now, along with these 5, I would say subsections, 3 more subsections are there, and everyone amongst us have heard a lot about it. That is related to royalty payments. So next one after this particular is interest payments. Post that it's royalty payments, and after that it's fee for technical services. So see, we need to understand section 9 itself has a huge gamut, and business connection in India can take hours and hours. So we would be restricting to a certain extent in this PowerPoint presentation, but yes, we would make sure that every point and everything is covered in the subsequent webinars related to this particular PPT. So in case of business connection in India, we would take it in detail, elaborate what business connection in India is in the subsequent PPTs, and so would royalty and FTAs and interest payments would be, because these are areas that require a whole lot of time to discuss, to understand. But because we have put in a few cases in the subsequent slides related to basically FTAs, so one thing is royalty, one thing is FTAs. Let's stick to FTAs, because what fee for technical services is. So fee for technical services is again defined in the subsections, clause 7 of section 9. And explanation 2, I suppose, mentions that any fee that is paid for managerial, technical, and consultancy services would be considered as a fee for technical services. Now, there are plethora of judgments, because managerial, technical, and consultancy are not defined in the Act. And there are judgments that we need to prescribe to understand what do you mean by managerial, what do you mean by technical, what do you mean by consultancy. along with this thing, it is very important for us to understand specifically in the case of FTAs that a lot of treaties mention that fee for technical services would only be taxable if we make it available. A make available clause that we use in a very general parlance, we say if it's a make available clause, then we whether to tax it or whether not to tax it. So if it is if the particular technical skill, a managerial skill, a consultancy is made available, should be taxable. If not made available, would not be taxable. So these are provisions that we need to deliberate in a lot of which need deliberation in a lot of depth, and that would be taken in the subsequent webinars for sure. I'll just go through a very important, or I would say very interesting decision of SkyCell. It's a Madras High Court decision wherein they say that okay, in case you use an aircraft from traveling to one place to another. So even while you're sitting in the aircraft, or let's say example of a bus, even while sitting in the bus, the engines of the aircraft, the engines of the bus are being used. So the entire technicality in that particular transportation vehicle is being used. Whether that will tantamount to a fee for technical services or not. Because in case it is tantamounting to fee for technical services, then the TDS liability, the taxation implications would come. But again, this is only a food for thought wherein will it tantamount to fee for technical services or not? The answer to this is no, this would not, but why would be covered subsequently. Okay.
Next, we come to an interesting case of Copal Research. So in this particular case, the share transfer, okay, this particular slide. So Copal Research India Private Limited is a subsidiary of Copal Research Limited, which is established in Mauritius. So Indian company is held by a Mauritian company, and a share purchase agreement takes place between Cyprus and Mauritius companies. That means Moody's Group Cyprus Limited wants to acquire the shares of Copal Research India Private Limited from the Mauritian entity, that is Copal Research Limited. Now in this particular case, a writ petition was filed by the revenue challenging the decision of AAR, holding that the sale of the shares of the Indian company by an entity incorporated in Mauritius to another entity incorporated in Cyprus would not be liable to be taxed in India in the hands of seller entity. So now again, we are seeing a non-resident to non-resident transfer. However, this is a direct transfer of shares because the shares are not being transferred through layering. Now, first we go through the AR ruling. The AR said that only a fraction of the value of shares from the overseas transferring entity was derived, that too indirectly from the value of the Indian company. Therefore, explanation 4 and 5 to section 9, as per the section 9, overseas assets shall derive substantial value from the Indian assets. Accordingly, it was held that the share transfer between the non-resident entities was not taxable in India in view of the provisions of section 9. And here, substantial value was held to mean 50% of the value of assets being transferred, which means in case the shares are being transferred, then the 50% of the value of those particular shares has to be derived from the Indian company. Also, as per many DTAAs, the provision for taxability of capital gain refers to 50% of the value of assets, and the DTAAs also say that the value shall mean the fixed assets, which means if the entire net asset value of the company is say 100 rupees and 50% of that value is derived from the fixed assets that the company has in India, then yes, it will be taxable in India. In case the 100 does not derive more than 50% of its value from India, in that case it would not be taxable in India. So now we come to the provisions.
Mughal, there was one question that was asked. What do you basically mean by made available? It's a make available thing. Again, I would reiterate, it's a very, very lengthy topic, but just to answer your particular question of make available related to FTS, make available is you would find this in the DTAA's double taxation avoidance agreements between India and the other country. So make available clause is a clause where in the FTS section, of course, in the FTS article, which usually is article 12 or 13, they say that if this managerial, technical or consultancy services are made available. Now, what do you mean by made available? For example, I give you a particular fee for technical service. So I give you a technical service. Let's say it falls under the category of technical service. So it's a fee for technical service. And the service should be such that after giving this particular service to you, you should now be capable of doing that particular service yourself, and you do not need my particular intervention in the service or my particular guidance in the service. That is the way wherein I have made that particular technical service available to you. So this is what is made available. A lot of treaties say that if it's a fee for technical service and the skill has been made available, then in that case it would fall and then the tax implications would come. So I would restrict this particular discussion about make available to this extent only, just for your understanding.
So broadly speaking, we will quickly take this up in the ensuing slides, wherein we will be covering the permanent establishment. Right now, we are only on the foreign remittances part. We also have a query that service received by a lawyer in foreign court and a lawyer firm does not have a P in India, whether liable to deduction under TDS or not. So there are various provisions. We'll be coming towards the service P, various forms of P in the ensuing slides. But then, yes, this is a very, very fact-specific question, and it has to be analyzed, keeping in view that what are the services, who is the firm, where is the payment made, where are the receiver and the payer situated.
See, in this particular case, the services of the lawyer has to be categorized whether the lawyer is giving a service as an independent personal service in India. Independent person, I'm sorry, in India. Plus, you have mentioned that there is no P in India, does not have a P in India. So in case there is no P in India, we do not have to go to the provisions of permanent establishment and see that whether the types of P that we would be discussing would be. Then we need to see that what type of services are these services basically, and whether these services have any nexus to India, so that we can basically say that these services are taxable in India. See, we need to understand only the services income that basically have nexus to the Indian territory and Indian jurisdiction, that we basically say a source rule thing. The income that is sourced from India in any particular manner is taxed in India. So being a very fact specific thing, we can basically get in touch about this particular fact that what type of services he's rendering. But if there is no P, don't get into the provisions of P and understand what is the nature of service, and then the tax implications would be decided.
So now coming to the documentation which is required at the time of making remittance. So a lot of queries that we got pertained to the documents, and how do we convince the foreign persons that there is a taxability in India, or on what basis is it to be determined. Then we'll be coming to the basis. The taxability or the P of a foreign company or the residential status of a foreign person has to be determined on the basis of documents. Now, number one, section 237A, as we earlier discussed, talks about that the TDS or the rate at which TDS is to be deducted is as per the Act, or the rates as per the DTAA. Now, section 90, we also discussed this, that section 90 states that either of two, whichever is more beneficial to the assessee, might apply. Now we come to section 206AA. Section 206AA says that in case of non-availability of PAN, tax is to be deducted at higher of the following amounts. That means in case a non-resident does not have a PAN in India, then higher of the three specified amounts would be applicable for the purposes of TDS. First is the rate specified in the Income Tax Act, which is the schedule to the Act. Next is the rates in force, which we just discussed, section 237A. And third is 20%. So higher of all these would be applicable for the TDS purpose. This was for PAN. However, Finance Act 2016 made an amendment to section 206AA, and it was said that in case a non-resident does not have a PAN, then there are certain alternate documents and information which have been prescribed. In case he furnishes that, then rigors of section 206AA, that is higher TDS rate, would not be applicable on the assessee. So they are broadly clubbed under Rule 37 BC of the Income Tax Act, of the income tax rules. We'll discuss that. So this slide covers the Rule 37 BC conditions, and it says that any interest, royalty, fee for technical services, or capital gain, in case they are earned by a non-resident, in that particular case, there's a relaxation from obtaining PAN and relaxation from rigors of section 206AA. However, the deductee has to furnish the following documents. Number one, the name, email ID, contact number, the address in the country of the specified territory outside India, of which the deductee is a resident. And third is the most important, this is the TRC, which also means the tax residency certificate. So you, at the time of making the remittance, have to obtain the tax residency certificate. Tax residency certificate is a statement which is issued by the revenue authorities of any country outside India, which specifies that this particular person for a specified calendar or a fiscal year is a resident in that particular country. And therefore, based upon that, this relaxation from 206AA is available. Also, the rule 37 BC talks about furnishing of tax identification number in the home country. Now we come to some of the provisions. Now it is a very interesting issue whether provisions of section 90 would be applicable or 206AA would be applicable. Whether in case I'm a non-resident, why should I go to the provisions of 206AA? Why can't I just take the benefit of DTAA? Because DTAA does not prescribe furnishing of these documents or deduction of tax at a higher rate. So there has been a plethora of cases, and based upon these decisions, you can note down the decisions. They are quite landmark judgments, and based upon these decisions, it was concluded, or it can be fairly concluded, that section 90 of the Act overrides the section 206AA. Now we come to the tax residency certificate. So it has the law of TRC has seen evolution, wherein it was introduced in Finance Act 2013, then amended in 2000. It was introduced in 2012, amended in 2013, and then further consolidated by notification number 57 of 2013, wherein certain additional documents and information were prescribed in Form 10F of the income tax rules. Now we come to the obligations of the payer. So after going through all the slides, it is quite we can comfortably say that the payer has a huge responsibility of firstly deciding whether what is the nature of the payment, what is the TDS applicable on the provision on the payment, whether TDS certificate is to be taken or not, whether the DTAA benefit would be applicable, what are the confirmations required, what are the documents which are to be obtained from a non-resident. Because tomorrow, if the case is picked up for scrutiny, then you will be liable to answer that why were the specific documents not obtained. Also, the deadlines and all the compliances are required to be done by the payer, and also obviously in case of short deduction or short deposition of TDS, the rigors of section 201 that we discussed earlier would fall upon the payer.
Before we proceed to the next case, Maninder, what you say is it a mandatory thing to obtain the documents? A mandatory thing? Yes, it is a mandatory thing to obtain the documents, of course. And whether or not the person or the entity is willing to give a TRC or not, you need to take a TRC because it's a mandatory document. The provisions of the Act makes it a mandate for you to collect a TRC so that you can know that the person, the other person, and by person I mean the entity or any other person as defined under the Act, is a resident of that particular country. Because until and unless you do not have a TRC, you do not have a document to state that I can take the benefit of the tax treaties that has been entered between India and the other country. Because it is a mandatory thing under the Act that if you want to take the benefit of the tax treaties, if you want to apply the provisions of the tax treaties that are beneficial vis-a-vis the Income Tax Act, you need to have these documents, and TRC is a mandatory document. Another thing, there were a few questions wherein you would fall under Article 7 or Article 12. See, and club membership fee. See, we need to understand anything that is paid to an entity outside India that can be characterized as a business income. And if that particular entity does not have a permanent establishment in India, then because it does not have a permanent establishment in India, that would not be taxable in India. But these provisions are interlinked. Fee for technical services, maybe Article 12 or Article 13. Sub-Article 6 or 7 would state that if this particular payment is related to the permanent establishment, it would fall under Article 7. So there is no straight yes or no to that particular, whether it will fall to Article 12 or 7. It all depends upon the facts of that particular case. But if it is a business income, and business income after being a business income, the entity does not have a permanent establishment in India, it is not taxable in India. Now, the same has to be analyzed in case for fee for technical services, the P aspect and the fee for technical services, as well as the royalty aspect and the fee for technical services. So these are certain interrelated provisions. Just to give you an overview of this particular thing.
Okay, so we have a question from Chetana. She's saying that whether TRC and Form 10F is to be obtained in all the cases, or is it only when we avail the benefit of TTAA? See, we just discussed that. We'll take you to the previous slide wherein we discussed that 206 as per the provisions of section 206 AA, in case a person does not have PAN, then following documents are to be obtained from that particular person. So whether you are it's always advisable whether you are availing the benefit of DTAA or not. But the primary question that arises before the revenue authorities, if your case is taken for scrutiny, would be whether the person was a resident of India or not. This is the primary case. In case the revenue authorities allege that that particular person was staying in India and was a resident of India, then you do not have a face in case you have not obtained for tax residency certificate. So tax residency certificate always insists the clients on obtaining tax residency certificate. If you also have a question from Maninder Singh on the similar issue that what to do in case they do not issue TRC, then practically you say that the transaction would be taxable at 20%. In case you want to avail any lower deduction, you provide us the all the documents which we just discussed.
And the reason for this is you would not like to take the onus of that particular thing. If you have the documents, you can deduct the taxes at the proper rates. If you do not have the documents, then you would be mandatorily required to deduct the TDS at the higher rates, because the payer would never want to fall in a particular category of defaulters wherein the provisions of section 201 subsection 1 would get implicated, and then you are paying interest because of the non-compliance unnecessarily. So it's always important to take the TRC.
Another important and a very practical thing that the Indian companies have started doing is that at the time of making the payment, in the agreement with the non-resident entity, they specifically mention that in case of any debate or any additional liability of TDS that arises in future, the liability or the entire expense would be the liability of the foreign entity in case the TDS is not deducted or deducted at a lower rate. So that is also something which can be which can be implemented or plugged in case it's a company to company transaction. So we'll come to the categorization of fee for technical services. We'll take two case laws wherein the Indian courts and the revenue authorities have deliberated upon whether a particular payment was in nature of fee for technical services. First case is the Kotak Securities Limited. It is a Supreme Court decision. The Kotak Securities Limited was making certain payments to BSE, Bombay Stock Exchange. The payments pertained to sale and purchase of shares and the online interface that they provide, wherein no human interfaces, wherein no human is required to provide any services. So it was held by the High Court that yes, these particular services are in the nature of fee for technical services. However, the Supreme Court overruled the decision of the High Court and said that all such fully automated services are available to all the members of stock exchange in respect of every transaction that is entered into. So the Supreme Court held that there was nothing special or any unique service which was in nature of fee for technical service that was made available. It was just an online application which was working in same manner for all the members and on all the screens. Now we come to third point, the services. It was held that the services provided by the stock exchange for which the transaction charges are paid fails to satisfy the aforesaid test of specialized, exclusive and individual requirement of customer or user, and therefore it was held that the payments are not in the nature of fee for technical services. That means the litmus test which has been laid down by Supreme Court is that the payment has to be specialized one, it has to be exclusive, and it has to have any individual requirement. It has to be customized. Now we take another case. Now this is the case of BSR and Co. BSR and Co, which we all know that is a affiliate member firm of KPMG. was making certain back-end payments, was rendering certain back-end services to the non-resident entities in various countries, and it was at the time of making the payments, the issue was whether the said services were independent personal services, and the said services were not in the nature of fee for technical services. Now, in this particular case, it was held that according to the relevant clauses of DTAA, and the services rendered do not fall under the ambit of fee for technical services. So, as I said, that there was nothing unique, or there was no human intervention. If it was a repetitive service, if it was something which was machine driven, then it cannot be said that it was fee for technical service. And there was no material to establish that there was any technical knowledge, skill, etc. that has been made available to the SSC. Therefore, it was held that there was no, since it was not made available, therefore there was no permanent establishment in India, and therefore the services can be treated as independent personal services. So also there was a recent decision wherein a Korean company hired the services of an expat who was providing services as a technical person, and he was independently appointed by the company. In that particular case, the services were held. It was held that the services were not in nature of fee for technical services, and the services were under the nature of independent personal services, therefore not taxable under the DTAA or under the Act.
Okay, so this thing pertains to permanent establishment. So post discussing a bit about permanent establishment, we'll take up this particular case. To answer a couple of questions, Kavi is asking, how would you get to know the surcharge amount on the non-residency? Kavi, see, if you have had previous transactions with that non-resident, you would have an idea that how much payments usually in a year you make. So basis that the surcharge would be applicable. If you do not have that, if you have a particular a rapport with a non-resident, then you can ask that what is the income that he earns from India. So this is these only. And if there is no way out, then you only have to rely upon the current transaction and the amount, and then levy surcharge. In subsequent transactions, if you feel that the threshold is being crossed, then the excessive levy can be whatever was deficient in the past can be done in the future.
So the last issue in the in the foreign payments, after which we'll proceed towards the permanent establishment, is the reimbursement of expenses. So it is very important to know that various all these rulings which are visible on the screen have laid down clearly that in case it's a reimbursement of any expenses or any recoupment of group recharge, in that particular case there is no income element, and in absence of any income element which is chargeable to tax, the reimbursement of expenses are not chargeable to the TDS provisions. So these are the case laws.
But just to add on what Mukul said, it's an important thing, because a lot of times we say that we are making payment on a cost-to-cost basis. You need to have a very, very robust documentation for the cost and the expenses that you have, because the authorities might just come back and say that this is not a cost-to-cost and you have a certain income element involved. So please make sure that you have robust documentation available with you, which substantiates that it is only the cost that is being given and nothing else. Just to answer one more question of Rakesh Raghav, that the lawyers from TRCs of foreign country and with no TDS would be deducted. See, by having a TRC, by having the other documentations, you can take the benefit of DTAA, that's fine. But we need to understand one thing, that if the lawyer is registered outside India, if the services are being rendered outside India, then and now the payment is being going from India. So what is the nexus in India is to be seen before we say that whether it is taxable in India, and if it is taxable in India, TDS would be deducted. If not, TDS would not be deducted. So just because you have a TRC, you would be able to take a benefit of DTAA, but by that we cannot come to a conclusion wherein TDS would be deducted or not be deducted. Now, coming to...
Okay, before we start the permanent establishment, one of the questions that was asked earlier as well is the taxability of foreign shipping companies and we had recently dealt with this particular case. So I'll tell you what the taxability or the foreign shipping companies is. So there's a specific, though the taxability is of the shipping companies and the airline companies is covered under section 44B and 44BBA, which prescribes the rate of 7.5% and 5% respectively for the taxability. However, for TDS purpose, there is a specific section, section 172, which overrides the entire Income Tax Act, and therefore provisions of section 195 are not applicable in the case of shipping companies. So section 172, you can go through that. It says that in case of a shipping company, the taxability would be ultimately decided by the port master. So you have to obtain an NOC from the postmaster, post which you will not be liable to TDS provisions, and you will ultimately your taxability as per the presumptive tax provisions that I just mentioned would be ultimately and conclusively decided at the time when the ship leaves the Indian shores, and that would be done by the respective assessing officer. Also, there are certain circulars. You can note down the names of the circulars, the numbers of the circulars. It's circular number 723 of 1995, and also circular number 732 of 95, which was specifically introduced in case of shipping companies, just to emphasize that the shipping companies are not required to comply with section 195. In case you have any specific doubt on the facts of your particular case, you can get in touch with us, because we've practically dealt with a particular case very recently. So now we continue with the permanent establishment.
Okay, so we will take up the queries that you are sending us. We will try to take up all the queries once we are done with the discussion of a permanent establishment. So now a permanent establishment, very what do you say? Use it. We use this term a lot of times. Now, what permanent establishment means, just to understand in a layman's term, is because of the globalization nowadays, the entities of jurisdiction outside India are coming to India, are operating in India. Similarly, Indian entities are going outside India and working outside India. So basically all the entities now have the entire world to work into. Now, because the entities are having various jurisdictions from where they can earn income from, the various jurisdictions also want, and they are in a rush to tax the income that is being earned from their jurisdiction. Maybe rightly so, because they basically say that this is an income, and like what I would be sticking to the context of India only. So Indian entity says that if you have earned certain income from India, then you pay tax to the foreign entities. So, and PE is also a very significant topic, because PE not only is connected to Article 5 of tax treaties wherein permanent establishment is explained, it is also related to Article 10, Article 11, Article 12. Article 10 basically deals with, I think so, dividends, then Article 11 is interest, Article 12 is royalty, fee for technical services. The reason I'm saying it is connected is all these 10, 11, 12 articles prescribe a reduced rate of taxation. But they also have an exclusion in the article itself that if it is connected to a permanent establishment, then a tax rate that is applicable on a foreign company would be applied. A very critical aspect, going further into permanent establishment, we would definitely not be discussing this aspect, is attribution of profit to the permanent establishment. That is a topic in itself. We would take it in a subsequent webinar, but we would be sticking here to understand that what permanent establishment and what type permanent establishments are there in respect to the Indian jurisdiction. Now basically what we have heard is that there are fixed place permanent establishment, number one. There is service permanent establishment, the second one. There is an agency permanent establishment. What we say is fixed place P, service P, agency P. Along with this, there are also construction Ps that are there. There is also a software P that is there. There is also a virtual P that is there. We would not be getting into it. Let's stick to the Ps that are famous. Let's stick to the Ps that we discuss, that we face. So to start off with, what would be a fixed place P, just to understand the context of a fixed place P? So we have this in the PPT, wherein as per the UN model, we have mentioned a definition of a fixed place P. I would read the definition first. The term permanent establishment means a fixed place of business through which business of an enterprise is wholly or partly carried out. Now we need to bifurcate this particular definition into various parts and understand how this definition plays out. What this definition says is that to have a permanent establishment, number one, there should be an enterprise, of course, who should be working. Number two, that enterprise should have a fixed place. A fixed place, now because we are talking about the Indian jurisdiction, in India. So that enterprise would have a fixed place in India. Okay, the enterprise, let's suppose, has a fixed place in India, then that particular enterprise should have a control over that fixed place in India. And remember, all these things are to be justified, or all these things are to be obeyed with together to make a permanent establishment. Now, again, going back, there should be an enterprise, then that enterprise should be having a fixed place in India. On that fixed place, the disposal of that enterprise should also be there. Okay, so there is an enterprise, there is a fixed place. The fixed place is also at the disposal of the foreign enterprise. Along with that, the foreign enterprise should be doing either wholly or partly some of its business activities from that fixed place in India. So let's delve further into this particular things. So let's suppose that an enterprise is doing, so a US entity, I'm just taking an example, a practical issue wherein a US entity is coming into India and using a particular premise to do its business activity. But it does not have a control over the premise where they are doing their business activities. And by control, what I want to say is that let's suppose one of your client is using your particular site to do its business activities. So one thing is that the client would just walk into your office, a desk is allocated to that client and he sits over the desk and he works in that desk. That means there is a particular categorical space that you have given to that US entity in India through which they are doing their business operations in India, and therefore this might just lead to a fixed place fee. What if that particular desk or that particular place cannot be used by the foreign entity in spite of doing a business in India? What if that foreign entity, every time they have to use a particular premise of the person, they have to take a permission of that particular person? They have to take, basically, post taking the permission only they could use. What if they do not have the ID cards to enter that particular premise? That means they do not have the control over that particular premise to use that particular premise. And why am I explaining is, in spite of an enterprise having a fixed place in India and doing a business in India, if they do not have a control over that premise, it might not lead to a fixed place fee. Let's take another example where an enterprise is coming into India and it has a control over a particular premise but is not doing any kind of a business from that particular premise. So in that case, if you are not doing any kind of a business of that particular US or UK entity, you would not be earning in India, and therefore there would be no fixed place permanent establishment in India. So in a nutshell, all these conditions, that is, an enterprise should be there should be a fixed place in India, and the fixed place should be at the disposal of the enterprise in India, and along with the disposal, you should be either wholly or partly carrying out the business activities in India. If all these conditions are satisfied, that will tantamount that a foreign enterprise would be having a fixed place permanent establishment in India. Okay, these were the rules for fixed place fee.
Yeah, just to take up a query, we have a query from Kavi. The query is that is PE required to be mandatorily registered with ROC? So now it's important to understand that a PE, or when I'm doing, so there are two modes of doing business with a country. Either I do business with a country, that means I'm remotely selling my goods, providing services, or I do business in the country. A question of permanent establishment will arise when I go beyond my domestic boundaries and I'm going and establishing an entity overseas and doing business. So whether a permanent establishment is required to be registered with the local laws is a question. Now the answer lies in the types in which the permanent establishment might be construed. So there are various ways in which I can go and do business in a country. It can be a branch office. For example, a branch office in India is required to be registered with RBI, and there are restrictions on the activities that the branch office can do. But then there's no involvement of ROC or any other regulatory authority. Similarly, if it's a subsidiary P That means if you have a complete entity set up in India, corporate set up in India, then yes, you are required to get it registered with ROC. Another form of permanent establishment would be agency P or an employee P, dependent agent P. In those particular cases, if you have agents in India, then they are required to register with the respective regulatory bodies, but not necessarily with the ROC. For example, if you have an employee who is rendering services for you in India, and it is alleged that you have a service fee, even in that particular case, you will not be required to go and register with the ROC.
Okay, in a nutshell, basically, if you are a registered entity in India, you would be required to have a registration. Just because you have a permanent establishment in India doesn't mean that you require a registration. So, in a nutshell. Second, if you say that there's a question from Neha that Indian company considered as a PE of a foreign, basically a foreign company having an Indian subsidiary. So Neha, a plethora of judgments are there. It would definitely and absolutely depend upon the activities that a subsidiary in India is doing for the foreign entity. Per se, prima facie, a subsidiary would automatically not become a permanent establishment of a foreign company. Subsidiary is absolutely a different entity working independently. We need to, so like a fixed place P, next we would be getting into service P and agency P principles. So if any of the conditions of these P would be satisfied by the subsidiary, then it might just fall under the permanent establishment definition. But just per se, having a subsidiary in India, a foreign company would not be considered a permanent establishment here. Okay, going forward with the service fee concept. So fixed place fee, we have dealt into the principles of fixed place fee. Now, a service fee would be when the employees of the foreign company, for example, let's say US company would come to India and would be rendering services on behalf of that foreign company in India, maybe to third party, maybe to someone to earn income in India. Now, an interesting aspect in service fee is that there is a certain threshold that is prescribed in the DTAAs. In certain, so maybe in certain DTAAs, the threshold is 90 days. So the 90-day threshold is that if the employees of the foreign company would be coming into India, would be rendering services in India, and they are in India for a period of more than 90 days, then that foreign entity would be a service fee in India. Now, do remember that we have a concept of solar working days, man working days to calculate the 90 days, which would be discussed maybe in subsequent webinars when we have a detailed webinar on service fee. Now, the next type of fee is basically agency fee. Now, what would be an agency fee is, to understand again in a very general term, is if you have an agent, if a foreign entity has an agent in India. Now, will every agent become a permanent establishment? No, that is not the scenario. What we need to see is that if you have an agent in India, if that agent is dependable upon you. Now, what do you mean by dependable is that economically and financially dependable upon the foreign entity. Let's suppose that I am working for a foreign entity in India and I'm working for 10 other entities in India and abroad. That means I'm not financially dependent upon that one entity and I would not be considered as an agent. Dependent agent, I forgive. In case I'm only working for that particular foreign entity in India and I'm only earning through that foreign entity and working on behalf of that foreign entity, then I might be a dependent agent of that foreign entity in India. Now, once you are a dependent and once you are considered as an agent, then to construct an agency P in India, to establish an agency P in India, you need to see various activities, and the various activities would be whether the agent is signing the contract in India on behalf of the foreign entity, where the agent is habitually getting into discussions of negotiations and concluding the contracts, whether the stock is being maintained by this particular agent. So if let's say an agent in India, a dependable agent, a dependent agent is here in India, so I am a dependent agent. And Mukul is a customer of that foreign entity. And if I go to Mukul and say that, okay, these are the pricing terms of the foreign entity, this is the agreement, I have the power and I am absolutely dependent on that foreign entity. Remember this financially. And I have the power to conclude this contract on behalf of that foreign entity. Then in that case, I am a dependent agent, which is nowadays known as DAPE also, DAPEE. I would be considered as a DAPE of that foreign entity, and then the allocation to the DAPE would be obviously there. So there are multiple checks in agency P wherein we see that number one, there should be an agent, not a principal to principal, there should be an agent. The agent has to be a dependent agent. Post becoming a dependent agent, you need to fulfill these three criteria. Let's say a criteria of signing the contract on behalf of the foreign entity, a criteria for concluding the contracts with the customers, a criteria of holding up the stocks for the foreign entity. If all these conditions are satisfied, then you would definitely become an agency PE also. So we would be sticking to this fixed place P wherein we have explained the principles. Then the service fee, again, we have explained that the employee of a foreign entity coming into India and rendering services in India is in India for more than 90 days. And then the agency fee, wherein there is an agent, the agent is dependent, and he's either signing the contract on behalf of the foreign entity, entering into negotiating the contracts. And negotiating, I don't mean just going and giving the price, I mean proper negotiations, almost at the verge of conclusion, or maintaining stock on a habitual basis in India. In that case, agency fee would be established. So this is what the principles of fixed place fee, service fee, and agency fee state.
So also, since we are discussing permanent establishment, I would also like to highlight that permanent establishment rules for a very long time have remained to be in the nature of form over substance, which means there were rules prescribed under the UN model, the OECD model, and the permissible tax avoidance was actually legal. That means if you are avoiding tax, or you're able to plan your tax in a legitimate manner, which is within the four boundaries of the DTAA or the domestic tax laws, then it was eligible. However, now there is a marked shift in the attitude of the revenue authorities globally. In fact, and this happened post 2008 economic crisis hit the European states. So now what the governments are saying is that nothing doing with the rules. Now they are implementing BEPS, which is base erosion and profit shifting. So briefly stating what really is BEPS. So base really means the taxable base on which I'm liable to pay taxes in a particular country. So what the MNCs were particularly doing is that they were reducing their tax basis by making royalty payments, by making IP related payments, by making reimbursements, by making secondment payments, by making group recharges. They were reducing and shrinking their base, taxable base, and shifting that base into a low tax jurisdiction, maybe Cayman Islands or any other jurisdiction which has lower or negligible tax rates. So in order to curb all these practices, base erosion and profit shifting measures were introduced. And now the OECD or the G20 have 15 weapons, 15 action plans. Action plans refers to the 15 areas which have been specifically targeted in order to fix these loopholes. So a classic case is the case of MasterCard that recently held in India before the Authority for Advanced Ruling. So the case was that MasterCard was operating in India for many years by form of a subsidiary. Subsequently, and they were paying all the due taxes in India. Subsequently, they eroded the entire taxable base from India, and they started operating through agency function, which means the subsidiary in India, the entity which was set up, was wound up, and all the operations were being subcontracted to the agents. In this particular case, the MasterCard was operating within the four corners of the DTAA and the Income Tax Act, through which they were able to take the tax benefits, or I would say do the tax planning in a manner that all the profits were getting transferred overseas. However, recently in this particular case, the Authority for Advanced Ruling held that MasterCard held a PE in India by the form of the transmitters that they have set up in various banks. So you can well imagine that what is the extent to which the authorities are going. And the AR even said that the business of the MasterCard was of such a manner that they did not require any company or any human intervention. They just wanted the data to be transmitted and verified and processed, and all the payments be processed in a respective manner. And that was being done by a simple transmitter, and that transmitter was held to be a P of the MasterCard in India. Therefore, it's not a simple thing whether a company has a P or not. You need to have robust documents. You need to have a very in-depth fact-based analysis of the operations, of the responsibilities, of the activities that the overseas activity undertakes. And also it's important to pre-decide the form in which the entity would be entering the offshores, whether it be branch office, whether it be subsidiary, whether it be agency, whether it be employees.
And please make sure when we say branch office, because specifically branch office is included in the definition of PE when we say Article 5. So it is very of utmost, it is very important and of utmost importance that when you decide to, or when one of your clients maybe decides to enter into India, they need to understand what would be the implications of permanent establishment of working in India. And one more thing that is very important and that is to be noticed and that is to be given an advice on is agreement drafting. Or maybe if agreement is drafting, vetting of those agreements. Because what happens is in a lot of cases, basically what happens is that the authorities prima facie ask for agreements. They would ask for agreements and they would look in the clauses of the agreements, and what they would say is that this agreement is very glaringly saying that there is income that is there is activity that is happening in India. Maybe there are agents that you have, because we certainly use terms as agents in the agreement. We certainly use terms such as commission in the agreement. So there are various terms, there are various clauses that are mentioned in the agreements, and agreements between the customers in India and the foreign entities outside India, agreements between the subsidiaries in India and holding companies outside India. And the agreements very categorically state that these would be the activities without really ring fencing the activities from a permanent establishment's point of view. So it is very important that we draft the agreements or help the client draft those agreements in such a manner that we ring fence the risk of a permanent establishment, so that tomorrow if the agreement is given to the revenue authorities upfront don't come and say that, okay, this is a very glaring kind of a clause which straight away states that you have a permanent establishment, and subsequent to that the client has a lot of problem substantiated that no, there is no P. Because a lot of cases nowadays you would see that they have put in the clauses of an agreement stating that these are the clauses due to which you have a permanent establishment in India. So do remember that agreement drafting is a very important thing. I would just like to take up a particular question wherein just dependency has any percentage. Mr. Angad Pal Singh is asking, as such, there is no percentage that is described anywhere. It is only the judicial precedents that basically say that maybe 90% of your income, maybe 95%, 85% of your income, if an agent is earning from the foreign entity, then you would be considered as a financially dependent agent. So per se, in the DTAS, there is no particular percentage that has been prescribed for the purpose of dependency.
So now we'll come to the landmark decision of Formula One World Championship, which is a marquee decision in many senses. As I just mentioned, in the case of MasterCard, the corporate veil was lifted by the courts, and the substance was actually checked. That even if a particular transaction is within the four corners of the DTAA or the OECD or the international tax literature, whether the substance remains to be tax benefit or the substance actually is driven by the activities, the risks that a particular entity takes. Now, in this particular case, the facts in brief are that Formula One, which had I think we can wind up in another 15 minutes. So in this particular case, JP Group purchased the rights of hosting the Formula One event on the Buddha International Circuit from the UK entity, and the payments that were made to the UK entity for those particular rights were structured in such a manner that they were disguised as royalty payments, that we are taking the rights, so this is the royalty payment that we are paying to UK company, and it was within the four corners of the DTAA. Now we'll just quickly go through the facts. The taxpayer UK resident company entered into a race promotion contract with JP Sports and granted rights to stage, host and promote the Formula One Grand Prix event. UK company also permitted JP to use the certain intellectual property. The participants of the event enter into agreement with UK company that would that they would not participate in any other similar event. UK company and JP both approached the AR. AR held that the UK company had no fixed place of business in India and held that the amount was taxable as royalty. UK company, JP, and the tax department, all three entities filed a writ petition before the High Court. And interestingly, the High Court said that this entire corporate veil has to be lifted, and it has to be seen that what is actually the nature of the payments, whether the UK company is only giving them a minor IP to run an event in India, or whether UK company is actually doing business in India. The concept that we discussed at the starting of the P section. So it's interesting to see the ruling of the Delhi High Court. It said that it was held that the UK company constitutes a fixed place of business. UK company had the right to access the circuit. So the circuit was held that was a fixed place. However, the event did not cross the threshold, the P threshold, which has been prescribed under the DTAA, but it was held by the Delhi High Court that the business was amply carried out by the UK company on the Buddha International Circuit. The nature of business was such that within a single race or within a limited period, it was able to generate the revenues which would be sufficient, or which would be the entire gamut of activities would be sufficient to constitute business in India. Now, UK company had the right to dictate who could access the circuit, and organizing any other event in the circuit was not permitted. UK company was entitled to 2 years payment of assured consideration in the event of termination of the contract based on the exclusive nature of the access and the period of access. The circuit itself constituted a fixed place business P. So the authorities held that the nature of business was such that circuit was sufficient to constitute a fixed place of business. Though the overseas entity did not own the circuit, however, it was available at their disposal, at their instructions for the business which is required to be conducted. Now, on the second last point, UK business income versus royalty. Since JP was obliged to host, stage, and promote the event, it was thus bound to use the logo's IP and wasn't otherwise authorized to use it. Therefore, the payment made by JP to the assessee based on the total amount of the revenue earned was in nature of business income and does not constitute royalty. So here the Delhi High Court overruled the decision of AR and held that there was a P of Formula 1 in India. There's an analysis, the permanence test that we just discussed. Permanence test actually says that the premises or any place of business should actually be available for the time during which a business can sufficiently be conducted. So for example, I might have a business which I can do within a period of 2 months. Somebody else might require the premises for a period of say 5-6 years. So that is a very, very business specific and a fact specific exercise. But if I can sufficiently conclude my business within a short duration, then that would pass the permanence test, and that may constitute my P. So now, whether the business of UK company is being carried out through the fixed place, as we just discussed, yes, the High Court held that the business was amply being carried out by the PE. Now,
so before we go forward, so this particular decision has been upheld by the Supreme Court itself,
right.
And the Supreme Court has also mentioned and categorically stated that there was a fixed place permanent establishment in India. And the interesting part is that the circuit was made the fixed place permanent establishment because there was an unrestricted, as we discussed in the beginning, the control. There was an unrestricted access that was available to the particular entity, to that particular circuit. And they, of course, were doing business in India through that particular circuit and earning revenues. So they had a fixed place. The fixed place was in their control because they were controlling who can enter, who cannot enter that particular circuit, and they were doing business in India and earning, and therefore they were having a fixed place P in India. I'm just connecting it to the principles that were explained by us earlier.
Right. So as we said, it's very, very important to understand the facts and do a fact-based analysis of each case. Now, in this particular case of G Energy Parts, it's a very, very unique case wherein all the documents and all the filings that were made by the assessee proved otherwise. So we'll just go through the facts. So the overseas company deputed a person to India for carrying out certain operations, and briefly stating that particular, they had drafted all the agreements in such a manner that the person did not constitute a P in India. However, the authorities again lifted the corporate veil and actually saw that what was the nature of the business of the duties that the employee was carrying out. And it was, and for this particular case, they went through and recorded the LinkedIn profiles of the employees, which clearly said that what were the functions. The LinkedIn profiles clearly mentioned that they were doing marketing activities, they are concluding the contracts, and had all the information, and that was recorded as proof by the authorities before the court to prove that the overseas company was actually doing business in India and had a permanent establishment via an employee. So this is an employee P.
So guys, please be important. Please be very careful when you put in job descriptions in LinkedIn's and Facebooks, because the department is having an eye on all these LinkedIn profiles.
Right. So whether the use of public domain information, whether that is permissible on the social networking sites or on the business networking sites, whether that is okay, whether that constitutional, whether that constitutes an additional evidence, that is still to be discussed. But that is something that we need to be conscious of.
You can fall into litigation trap if you're putting in that we are working in India in the LinkedIn site for an entity or employer of foreign entity.
Right. So another case is Carpet SA, which is a case of Chennai ITAT. In this case, again, this is a case of agency or an employee P, wherein a particular person was deputed to India and he was solely working as the agent of Carpetech, concluding contracts independently, negotiating the contracts, receiving the payments, doing all the marketing activities, and therefore the authorities held that Carpetech SA had a permanent establishment in India.
Okay, so we'll take one more related to an agency P. So that is not there in this particular PPT, but the case was interesting. The case is basically of NetApp, and it's a high court judgment. So why this is interesting is because a lot of foreign companies operate in India in such particular manner, wherein they have someone in India, maybe the subsidiary, maybe an agent, maybe a distributor, who would go and see the market for the products, who would basically see the segment of the market wherein the products can be sold, who would see what all prices can be there at which the products can be sold, who would advertise the products on behalf of the foreign entity. So all the business promotion activities, the market research activities, all these things would be done by someone in India for a foreign entity, because foreign entity wants to sell its products or maybe its services in India. So in NetApp BV, what was happening was that the Indian end, so this is between Netherlands and India. So the Indian entity of the Netherlands group, what they were doing was they were marketing and they were basically marketing and giving a sales support. They were basically assisting in organizing trade shows, ascertaining market trends, competition analysis, and certain support services before the sales activity was done. So because of the time crunch, I would jump on to the conclusion of this particular thing, that because they were doing all those things, and as you remember, we mentioned at the time of explaining agency P that you need to be dependent, and along with being dependent, you need to conclude the contracts or negotiate a contract up to the time of conclusion, let's say. Here, the entity in India was actually just doing a marketing activity, a business support activity, but nowhere was anyone involved in conclusion of the contracts. Nowhere was anyone involved in negotiation of the prices to an extent that the prices are almost finalized. Please do understand that the negotiations might be done initially, but to the extent of finalization of the negotiations would be very, very important contracts. So in this particular case, no one was involved in signing of the contract, negotiating the contracts up to the intent of finalization of the contracts. And because of these particular factors, there was no agency P that was held. So the Indian entity was not held to be an agency P of the foreign entity. Along with this, the foreign entity was not sending any of its employees in India. So therefore, the service P angle went out of scope. And again, the business of the foreign entity was not being conducted here in India. Only a market support activity was happening. Therefore, a fixed place P question also was not contended in this particular case.
So now some of the concluding thoughts, some of the points that you have to be conscious about while making foreign payments and at the time of determination of permanent establishment. So at the time of making foreign payments, it is important to understand and analyze the applicability of TDS, and the nature of payment is very, very crucial for that. Then you have to analyze whether there is a requirement for obtaining lower deduction certificate. In case you are not sure, then it's always better to obtain an LDC rather than go ahead and live with the exposure of income tax authorities scrutinizing your TDS payments. Then it is also important to note and obtain the documents from the NR before making any payments. As I mentioned, it is challenging, but yes, you have to say, boss, the payment, either you furnish all the documents, TRC and all, or the payments would be deducted at 20%.
As far as the things that you need to understand or analyze before having a permanent establishment in India is, you would have to primarily see the activities that are being done and who is actually doing the activities. So primarily, as I said earlier, subsidiary would not prima facie become a permanent establishment. But if a subsidiary is doing all those activities and giving the premises for having a business of an entity outside India, it might just get into a PE in it. Similarly, if you're having an agent is dependent, you might get into a permanent establishment net. And if an employer of a foreign entity is coming into India, they might fall into a permanent establishment net. But please do analyze each and every aspect very, very minutely, because even a point of negotiation, how much can an Indian entity or an Indian agent negotiate is very important to understand and determine the constitution of a permanent establishment in India. Along with that, we have just discussed the establishment of a P in India. Along with that, once a P is established, a very important aspect is why is a P so dreadful? The reason for P being so dreadful is because there is an attribution of income that is done to the P. There is a certain attribution of the global income that is done to the permanent establishment. A foreign entity's 60%, 40%, 80% global income would be attributed to the P in India and would be taxed in India at 40%, and above that surcharge and education cess and everything. So attribution is a very, very important aspect. We'll be covering in subsequent webinars, of course. So to understand a P, each and every activity, who is doing that activity, how much attribution can be done, everything is to be analyzed very minutely and very nicely.
So just to take with this, we end today's session, and we'll just try to take as many questions as we can. So there's a question from Kavi that in case of shipping companies, even if there's section 172, still IT department insists on lower deduction certificate to shipping companies. So in our practical experience, yes, it is always better that you take an LDC. There is a provision of section 172 and the circulars that I mentioned, 722 and 723. However, it's always easier that you approach the income tax authorities. In our particular case, we were able to obtain a certificate of TDS less than 1%. So that is what we did, and then all the payments were being done at that particular at that particular rate. And at the time of final, when the contract of the shipping company with the charter agreement ended, at that time the final scrutiny happened.
Okay, so with this, we hope that you guys enjoyed, had a learning session. We also enjoyed interacting with you, taking all your questions. And in case are there any questions that are unanswered, any questions that further come to your mind, you would want to ask us certain queries, certain answers, you can always get in touch with either Mukul or me, or you can email us. Our details are of course there with you now in the presentation, and we hope to see you in the next webinar pretty soon.
Right. And as we mentioned earlier, that we'll be taking subsequent seminars or the webinars on specific topics. So in case you have any topics in mind, you can always get in touch with us.
Absolutely.
And for that particular topic, we can take the seminar.
Absolutely.
So we hope the seminar was helpful to you, and thanks a lot.
Thank you for your time, everyone. Thank you.